Hey there, finance enthusiasts. Welcome back to For Credit Guys. If you're joining us for the first time, we're diving deep into the world of securitization. Today, we're tackling part 2 of our Top 20 Securitization Interview Questions series. Whether you're prepping for an interview or just want to boost your financial knowledge, you're in the right place. Let's jump right in. Question 1. How do credit enhancements work in securitization? All right, let's break this down. Credit enhancements are like safety nets in securitization. They're designed to reduce the risk for investors and improve the credit rating of securitized assets. Here's how they work. Overcollateralization. This is when the value of the assets in the pool is greater than the securities issued. It's like having extra cushioning. Subordination. Think of this as a priority system. Some securities, senior tranches, get paid first, while others, junior tranches, absorb losses first. Reserve accounts. These are like emergency funds set aside to cover potential losses. Excess spread. This is the difference between the interest earned on the asset pool and the interest paid out to investors. It can be used to cover losses. Third-party guarantees. Sometimes an external party might guarantee payments, adding an extra layer of security. These enhancements work together to make the securities more attractive to investors by reducing their risk. Question 2. What are the roles of different parties in a securitization transaction? Securitization is like a big team sport, with each player having a crucial role. Let's meet the team. Originator. This is where it all starts. They create the original loans or assets. Sponsor. They buy the assets from the originator and get the securitization ball rolling. Issuer, Special Purpose Vehicle or SPV. This is a separate entity created to hold the assets and issue securities. Underwriter. They help structure the deal and sell the securities to investors. Trustee. They oversee the SPV and ensure everyone plays by the rules. Servicer. They collect payments from the original borrowers and pass them on to investors. Rating agencies. They assess the risk of the securities and assign credit ratings. Investors. Last but not least, they buy the securities. Each of these parties plays a crucial role in making the securitization process work smoothly. Question 3. What are some common types of assets that can be securitized? Securitization is pretty versatile. Here are some common assets that often get the securitization treatment. Mortgages. This is a big one. Both residential and commercial mortgages can be securitized. Auto loans. Your car loan could be part of a securitized pool. Credit card receivables. Those credit card payments you make might be securitized. Student loans. Yep, even student debt can be securitized. Corporate loans. Big business loans are fair game too. Leases. Both equipment and real estate leases can be securitized. Royalties, even future income from things like music or patents can be securitized. The key is that these assets generate predictable cash flows, which is what makes them suitable for securitization. Question 4. Explain the waterfall structure in securitization cash flows. Picture a series of cascading pools. That's your waterfall structure. It determines how cash flows are distributed among different classes of securities. Here's how it typically works. Top of the waterfall. Cash flows first go to the most senior securities, usually rated AAA. These get paid in full before anyone else sees a dime. Middle tiers. Once the top tier is paid, cash flows to the next level and so on. Bottom of the waterfall. The most junior securities, often unrated, only receive payments if there's cash left after all senior obligations are met. Excess cash. Any leftover cash might go back to the originator or into a reserve account. This structure is why different tranches have different risk levels and returns. The higher up the waterfall, the lower the risk, and usually the lower the return. Question 5. What are some key risks in securitization and how are they mitigated? Like any financial instrument, securitization comes with its share of risks. But don't worry, there are ways to manage them. Credit risk. This is the risk that borrowers won't pay back their loans. Mitigation. Credit enhancements, careful asset selection, and diversification. Interest rate risk. Changes in interest rates can affect the value of securities. Mitigation. Interest rate swaps or caps. Prepayment risk. This happens when borrowers pay off loans early. Mitigation. Structuring deals with prepayment penalties or using planned amortization classes. Liquidity risk. The risk that securities can't be easily bought or sold. Mitigation. Creating more standardized securities and improving market transparency. Operational risk. risks from human error or system failures. Mitigation, strong internal controls and regular audits. Legal and regulatory risk, changes in laws can impact securitization. Mitigation, staying up to date with regulations and using expert legal counsel. Remember, while these risks can't be eliminated entirely, understanding and managing them is key to successful securitization. And there you have it, folks. We've tackled 5 more crucial securitization interview questions. Remember, understanding these concepts isn't just about acing interviews. It's about grasping the mechanics of a significant part of our financial system. If you found this video helpful, don't forget to hit that like button and subscribe to 4 Credit Guys for more finance insights. Got questions? Drop them in the comments below. And if you're hungry for more, check out part 1 of this series if you haven't already. Thanks for watching, and we'll see you in the next video.